Well, this is your Wall Street wake-up call. Morgan Stanley is out with second quarter earnings of 75 cents a share, beating estimates of 59 cents. Revenue of $8.9 billion, topping estimates of $8.3 billion, but was lower year over year. So here with more analysis is David Leibowitz, the global market strategist at JP Morgan Asset Management. So David, Morgan Stanley, the latest bank to beat estimates. How would you characterize bank earnings over the past week? Were the estimates too low?
So I think the estimates maybe were a little bit too low, but I think you're still seeing a mixed picture out of the financial sector. On the one hand, very low interest rates are impacting net interest margins. That's going to be kind of a structural headwind for financials going forward. But on the other hand, you're seeing trading activity pick up. You're seeing better news in terms of lending. And so, right now financials are in a bit of a tug of war with, on the one hand, very low rates impacting their profitability, but on the other hand, some of the more traditional drivers like, again, trading and lending coming back into play.
But are you a buyer of the financial sector in your group?
We are. We like financials. We like the more cyclical sectors of the market. Right now we're seeing what I like to call a valuation imbalance, where you have utilities, you have these safe haven defensive sectors that are looking very, very expensive. Yes, they've delivered return over the course of this year, but from a valuation standpoint, they don't really look attractive. The cyclicals, on the other hand, things like financial, consumer discretionary, technology, they should benefit as interest rates gradually rise, and from a valuation standpoint are much more attractive.
And earlier you mentioned the low rate environment. That brings me to my next point about tomorrow's European Central Bank meeting. What do you expect there? I mean, if the Bank of England didn't do anything when they last met, post-Brexit, why should we expect the ECB to do anything in terms of stimulus?
So I'm not sure the ECB is really going to do anything tomorrow, but I think you will get more clarity on what they plan to do before the end of the year. Right now, quantitative easing in Europe is set to expire in March of 2017. They're going to need to revisit the policies surrounding that. I mean, they're literally running out of bonds to buy. So I think we'll get an indication from the ECB of what might be coming in September, but I think they'll stay on hold tomorrow, similar to what the BOE did. Look, these guys just want more information before they make a big decision.
All right, now with the market rally we've been seeing with these continuous highs in the Dow and the S&P, is that a theme for the rest of the year? I mean, is it possible that should we get even more stimulus from one of these central banks, that the market sort of reverses course? The thinking that that's one less tool the central bank has if we do indeed fall into a recession. I mean, how sort of outlandish some of the market psychology can be.
Yep, and right now I think we're in an environment where good news is good news. So central banks doing more, economic growth coming back, companies beating earnings estimates. The market really likes all of this. The problem is there's a lot priced into this market. There's a lot of optimism priced into this market, and things will need to play out in a very specific way over the remainder of the year in order for these levels to be maintained or for the market to push higher. So we're cautiously optimistic at current levels. We think that earnings growth will come back in the second half, and that'll be the driver of market returns in the second half of this year. But I think investors need to be cautious, and I think the consolidation that we're seeing right now is a testament to the fact that we need a clear catalyst if we're going to break further to the upside.
All right, and just quickly, I believe, though, the S&P 500 has already met your year-end target, if I'm not mistaken, right?
So we've met our return target for the year. We've been thinking, mid to high single-digit returns. I think that there's some upside from here, but again, I think that upside is really dependent on the fundamentals coming back. So I think it's going to be a grind higher rather than a shot higher, like we saw in the wake of Brexit.
All right. Well, David Leibowitz, the global market strategist at JP Morgan Asset Management. David, always great to see you. Thank you.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.